After 20 years, you stop being surprised by how traders fail. It's never the strategy. It's never the market. It's the same patterns playing out in different accounts, different time frames, different asset classes. Smart people, experienced people, people who know better. And the strangest part, they know what they're doing wrong while they're doing it. I've watched traders with decades of screen time blow up accounts over problems they could articulate perfectly. They'd explain their mistake in detail, write it down, promise to fix it, then repeat it 3 weeks later. This isn't about tactics. This is about the psychological traps that smart traders walk into despite knowing they exist. The ones that survive after you've read the books and paid the tuition. If you're still here after a few years, still frustrated, still resetting, this is what you're missing. Here's what's actually happening. You already know you need discipline. You already know position sizing matters. You've probably already learned not to revenge trade, but knowledge stops helping at a certain point. And most traders hit that ceiling without realizing it. What separates consistency from endless resets isn't more information. It's understanding why you sabotage yourself when you know exactly what you should do. Why your brain convinces you that this time is different. Why emotional control feels impossible on Tuesday but effortless on Thursday. By the end of this, you'll understand the gap between knowing and doing. Not how to close it overnight, that's not real, but why it exists and what's actually keeping it open. The first problem shows up right after your best trades. You nail a setup. Perfect entry, perfect exit. You follow your plan exactly, and the market rewards you for it. Feels clean. Feels right. Feels like you figured something out. 2 days later, you take the same setup with triple the position size. Not because the setup is better, not because your analysis improved, because somewhere between the winning trade and this one, your brain decided the risk was lower than it actually is. Here's the lesson. Success doesn't teach discipline. It teaches overconfidence. Winning makes you feel more skilled than you are. Your brain interprets a correct prediction as increased ability to predict. Those aren't the same thing. One good trade doesn't mean the next 3 are safer, but it feels that way. The traders who survive learn to distrust the feeling of being right. This connects directly to the next trap. Most traders think they need to feel confident before they take a trade. They wait for certainty. They want conviction. They want the chart to feel obvious before they commit capital. Here's what that looks like in practice. You're watching a setup develop. It matches your rules. Your edge is there. But it doesn't feel strong enough yet, so you wait. You wait for one more confirmation, one more piece of data, one more signal that says, this is definitely going to work. By the time you feel certain enough to enter, the move is halfway over. You either chase it and get trapped, or you skip it and watch it work without you. The lesson: certainty is expensive. Every moment you spend waiting for confidence is a moment the market is already moving. The edge exists when your rules trigger, not when your emotions agree. Chasing the feeling of certainty is just another way to buy high and sell low. Professional traders act on rules, not conviction. But here's where it gets more subtle. Some traders solve this. They stop waiting for confidence. They start taking trades mechanically. They execute on signals even when they don't feel perfect. Then they realize they're over-trading because they confused action with discipline. They started equating activity with control. If waiting for certainty was the problem, constant execution must be the solution. So now they're in every setup. Every signal gets taken. Every rule match becomes a position. And they're still losing, but now they're losing faster. Here's the actual lesson. Discipline isn't taking every trade. It's taking the right trades and doing nothing the rest of the time. The hard part isn't pulling the trigger. The hard part is sitting on your hands when the trigger conditions aren't met. Most of trading is waiting. The traders who can't tolerate waiting find reasons to trade anyway. If you're constantly active, you're not disciplined. You're just anxious. This is why the next problem catches people off guard. You build a solid routine. You follow your rules. You manage your risk properly. Everything's working. You're not overtrading. You're not revenge trading. You're not gambling. But you're emotionally exhausted. You sit down to trade and you feel flat. Not emotional, not impulsive, just tired. So you think, good, I'm finally calm. I'm finally disciplined. This is what consistency feels like. Then you start missing setups because you can't generate the energy to care. You skip trades that match your rules because pulling the trigger feels like too much effort. You watch your edge appear and disappear without acting on it. The lesson. Emotional calm isn't the same as discipline. You can be completely calm and completely checked out. You can have zero emotional reactivity because you have zero emotional investment. That's not progress. That's burnout wearing a disguise. Discipline requires enough arousal to act decisively when your rules trigger. Too much emotion breaks you. Too little emotion makes you hesitant. The target is a controlled, engaged state, not flatlined. If you miss this, everything before it stops working. Most traders approach trading psychology like they're trying to remove emotions from the process. They think the goal is to become a robot, detached, mechanical, unaffected by wins or losses. So they numb themselves. They practice not caring. They train themselves to feel nothing when they're in a position. Here's what happens. You're in a trade. It moves against you. Your rules say exit, but you don't feel the urgency to act because you've trained yourself not to feel anything. So you give it more time. You let it go deeper. You rationalize waiting because there's no emotional signal pushing you to act. The lesson, you need emotions. You just need the right ones. Fear isn't the enemy. Paralysis is. Greed isn't the enemy. Rationalized rule breaking is. Emotions are data. They tell you when something matters. The problem isn't feeling them. It's acting on the wrong ones. Good traders don't eliminate emotions. They use emotions as feedback and execute on rules. This problem doesn't show up immediately. It shows up later. You build a system, you backtest it, you forward test it. You know it has an edge, you trust the numbers, you commit to following it, and you do. For 3 months, 6 months, maybe longer, then you hit a drawdown. Not unusual. Well, within normal parameters, your system accounts for this. You knew it was coming eventually. But somewhere in the middle of that drawdown, you start looking at other strategies. Not because your system stopped working, not because the edge disappeared, but because your brain needs a narrative that explains why you're losing. And normal variance doesn't feel like a good enough reason. The lesson. Your brain hates randomness. It will invent patterns to explain noise. It will create stories to justify bad luck. It will convince you that the system is broken because accepting that losses are random feels unbearable. The traders who last know that variance doesn't mean anything. A drawdown isn't a message from the market telling you to change. It's just probability playing out. Consistency isn't staying disciplined when you're winning. It's staying disciplined when randomness is working against you. Most traders think this part is harmless. You take a loss. Clean stop out. You followed your rules. You managed your risk. Everything went according to plan. But you feel bad. Not frustrated, not angry, just disappointed in yourself. You internalize the loss. You treat it like a personal failure, like you should have seen it coming, or done something differently, or been smarter. So you sit down and review the trade. You analyze every candle. You look for the mistake. You search for what you missed. And here's the trap. Sometimes there isn't a mistake. Sometimes the trade was correct and the market just didn't cooperate. Sometimes your edge played out exactly as expected and you were on the wrong side of probability. The lesson, not every loss is a lesson. Some losses are just the cost of doing business. If you treat every loss like a puzzle to solve, you'll start inventing problems that don't exist. You'll tweak your system to avoid a loss that was unavoidable. You'll optimize for the past instead of the future. Good traders review losses to find mistakes. Great traders know when a loss doesn't mean anything. This is where it gets worse. You understand that losses are part of the game. You understand that variance happens. You understand that your edge plays out over a sample size, not on individual trades. So you decide you need better emotional regulation. You need to control your reactions. You need to fix your psychology. You start meditating. You start journaling. You work on mindfulness. You try to reset your mental state before every session. And none of it helps because you're treating a behavior problem like it's a psychology problem. Here's what's actually happening. You have bad habits, mechanical behavioral habits. You click too fast. You adjust stops based on fear. You check your profit and loss too often. You enter before your rules confirm. The lesson? Psychology doesn't fix behavior. Behavior fixes behavior. You can't meditate your way out of a bad habit. You can't journal your way into discipline. Emotional regulation is important, but it's downstream from process. If your behavior is broken, your emotions will reflect that. Fix the process first. The psychology follows. This connects to why the last point fails without this one. You fix your behavior. You build better habits. You stop clicking too fast. You stop adjusting stops. You stop checking profit and loss every 30 seconds. You're executing cleanly, following rules, acting like a professional. Then one day you take a trade, it goes against you immediately, and you close it before your stop gets hit. Not because you were emotional, not because you panicked, because you sensed something was wrong, because your intuition told you to get out, because you felt like this one wasn't going to work. And maybe you were right. Maybe the trade would have stopped out anyway. But now you've created a new problem. The lesson, intuition, is just pattern recognition from your bad habits. Your brain learned that exiting early sometimes saves you money. It learned that ignoring your rules sometimes works. So now it feeds you intuition that's actually just reinforcement from the times you broke your rules and got lucky. Real intuition is built on thousands of hours of correct behavior. If you're still building the behavior, your intuition is just rationalization. Trust your rules, not your gut. Here's what most people don't realize about trading psychology. You think the goal is to master your emotions so you can execute perfectly. You think if you can just control fear, greed, and impatience, you'll be consistent. But execution isn't the finish line. Execution is the baseline. The real challenge shows up after you can execute, after you can follow your rules, after you can manage your risk and take your stops and avoid revenge trading. The real challenge is dealing with success without destroying it. You have 3 good months, 6 good months, maybe a full year. Your account is growing. Your confidence is real this time, earned based on actual results. Then you start taking bigger risks, not intentionally, not recklessly, just gradually. A little more size here, slightly wider stop there. 1 extra trade per day that's close enough to your rules. The lesson: success is harder to manage than failure. Failure is obvious. You know when you're losing. You know when you're broken. Success is subtle. It creeps into your process, disguises confidence. It convinces you that the rules can bend because you've proven you know what you're doing. The traders who blow up after consistency aren't the ones who never learned discipline. They're the ones who forgot why they needed it. This is the part that took me the longest to understand. You think trading psychology is about controlling yourself, about managing your mind, about staying disciplined under pressure. And that's true. But it's not the whole picture, because here's what actually happens when you get serious. You build discipline. You build process. You build consistency. You remove emotion from execution. You follow your rules like a machine. And then you get bored. Not frustrated, not burned out, just bored. The act of trading stops being interesting. It becomes repetitive, mechanical, monotonous. So you start looking for ways to make it interesting again. You start taking trades outside your system because they're more challenging. You start experimenting with new strategies because your current one feels stale. The lesson: if trading feels boring, you're probably doing it right. Excitement in trading is usually a symptom of too much risk or too little structure. The most profitable traders have the most boring days. They wait for their edge, execute their edge, and do nothing the rest of the time. If you need trading to be interesting, you're using it to meet a psychological need it wasn't designed to meet. Find your excitement somewhere else. But this is where most traders stop. They figure out discipline. They figure out process. They build a system that works. They execute it consistently, and they assume they're done. They think trading psychology is a problem you solve once, and then it's handled. Here's the reality: you're never done. The problems don't go away. They evolve. You stop overtrading, but now you undertrade. You stop chasing, but now you hesitate. You stop being emotional, but now you're detached. You stop breaking rules, but now you're rigid. Every solution creates a new edge case. Every problem you fix reveals another problem underneath it. The lesson: trading psychology isn't a destination. It's a management system. You don't solve it. You maintain it. The question isn't, how do I fix this forever? The question is, How do I recognize when I'm drifting incorrect before it costs me? The best traders aren't the ones who never have problems. They're the ones who catch problems early. This is why experience doesn't always help. You'd think that after a few years, you'd stop making mistakes. You'd think the lessons would stick. You'd think that once you learn something, it stays learned. But trading doesn't work that way. You can go 6 months following your rules perfectly. 6 months of clean execution, 6 months of professional behavior. Then one day, for no obvious reason, you revenge trade. Not because you forgot the lesson, not because you don't know better, but because your brain is tired, because you had a bad day outside of trading, because you slept poorly, because you're human. The lesson. Knowledge is not immunity. You don't build a tolerance to psychological traps. You just get better at recognizing them. You get faster at correcting them. You get more aware of the conditions that make you vulnerable, but you never stop being vulnerable. The moment you think you've moved beyond a problem is usually the moment right before you repeat it. Here's the thing that nobody tells you about long-term consistency. It's not about motivation. It's not about discipline. It's not even about psychology. It's about identity. Most traders approach trading like it's a skill they're learning, like it's a job they're training for. They think if they just get good enough, if they just learn enough, if they just build enough discipline, then they'll be consistent. But consistency doesn't come from skill. It comes from who you are. At some point, you stop being someone who trades and start being a trader. Not because you're profitable, not because you've hit some arbitrary milestone, but because your behavior reflects a set of principles you don't compromise on. You don't follow your rules because you're disciplined. You follow your rules because breaking them would mean becoming someone you're not. The lesson. Trading psychology is downstream from identity. If you see yourself as someone who's working on discipline, you'll always be working on it. If you see yourself as someone who operates with discipline, it stops being a choice you make and starts being a standard you maintain. The shift from trying to be consistent to simply being consistent happens when your behavior becomes an expression of identity, not an achievement you're chasing. But even that isn't the end. Because here's what happens when you finally build that identity. You become a different person than the one who started trading. Your risk tolerance changes. Your goals change. What motivated you 5 years ago doesn't motivate you now. And you have to decide, am I trading because this is who I am? Or am I trading because it's what I've been doing? Some traders reach consistency and realize they don't want it anymore. They built discipline, built a process, built an edge, and then discovered the life that comes with it isn't the life they actually want. The lesson. Trading psychology includes knowing when to stop. Not because you failed, not because you couldn't make it work, but because the cost of staying consistent is higher than the reward. Some of the best traders I know quit, not because they blew up, not because they lost discipline, but because they were honest enough to admit that winning at trading meant losing at something else that mattered more. That's not failure, that's clarity. So here's what 20 years looks like compressed into 15 minutes. You start trading thinking it's about finding the right strategy. Then you learn it's about managing risk. Then you learn it's about managing yourself. Then you learn it's about managing your expectations of yourself. You spend the first few years learning what works. You spend the next few years learning why you won't do what works. You spend the years after that building systems to force yourself to do what works anyway. And if you last long enough, you realize the real skill isn't trading. It's self-awareness. Knowing when you're lying to yourself. Knowing when you're rationalizing. Knowing when you're drifting from your process. Knowing when you're vulnerable. The traders who make it aren't the smartest. They're not the most talented. They're not the ones with the best strategies. They're the ones who are honest about what they see in the mirror. Now here's the part that doesn't fit neatly into a lesson. Understanding everything I just said doesn't fix it automatically. You can know every trap. You can see every pattern. You can recognize every psychological mistake the moment it's happening. And you'll still make them. Because knowing and doing are separated by something that doesn't respond to logic. They're separated by habit, by wiring, by the accumulated weight of every trade you've ever taken. You can't think your way into different behavior. You can only behave your way into different thinking. This is why trading psychology feels impossible, because it is impossible if you're trying to solve it with understanding. Understanding is the map. Behavior is the territory, and you can't navigate the territory by staring at the map. So the question isn't, how do I learn this? The question is, how do I build the system that makes this automatic? Because the traders who last don't rely on remembering the lessons. They build environments, routines, and feedback loops that make the right behavior the path of least resistance. They automate discipline, they systematize self-awareness, they remove the decision points where they're most likely to fail. That's the actual work, not learning psychology. Building the infrastructure that makes psychology irrelevant. And that's the problem you still have. Understanding this is the easy part.